Open a cruise booking site right now and start filtering by cruise line. Watch what happens to the screen. Logos populate. Carnival, Princess, Holland America, Cunard, Seabourn, Celebrity, Royal Caribbean, Norwegian, Oceania, Regent Seven Seas, Costa, Ada, Silversea, MSC, Virgin Voyages. 15 names, 15 distinct vibes. Budget party ships and white-glove transatlantic ocean liners sitting in the same drop-down menu. The whole thing looks like a competitive market. Lots of players, lots of choices, lots of ways to sort yourself by taste and budget and how you feel about formal dinner nights. Here's what that drop-down is actually showing you. Roughly 3 out of every 4 cruise passengers on the planet step onto a ship owned by one of 3 companies. 3. And those 3 companies have built something genuinely clever. A market that looks like 12 competitors and is, structurally, something closer to a 3-company world with a lot of very well-maintained logos on top. The way this happened isn't a secret. It's a business story that unfolded over about 30 years, one acquisition at a time. And the geography of how these companies are structured, where they're incorporated, where their ships are registered, and what that means for the economics is public, disclosed, and rational in a way that gets more interesting the closer you look at it. So, take a closer look. Back in the early 1980s, the cruise industry was genuinely fragmented. A handful of mid-sized operators, mostly regional itineraries, no dominant player. Carnival Cruise Line existed, and it was doing fine. The fun ship positioning, working class cruising, Miami to Nassau runs. But it wasn't running the industry. Then Carnival started buying things. Holland America, 1989, a century-old Dutch line with a distinct identity. Older demographic, Alaska and Pacific Northwest itineraries, a particular kind of stately elegance. Carnival bought it and did something that, in hindsight, defined the entire consolidation era. They kept it exactly as it was. No rebranding, no importing the Carnival aesthetic onto Holland America's ships. The 2 brands continued operating as if they had nothing to do with each other, which, from a passenger's perspective, they essentially didn't. This is the move that made everything else possible. Carnival had figured out that cruise brands have real cultural weight. Passengers are loyal to them. They carry associations. They signal something about who you are when you book them. Folding an acquisition into the parent brand would destroy the thing you just paid for. Leaving it alone preserves the asset and lets you run the 2 brands against different markets simultaneously. Which is also the moment you need to sit with for a second, because it's where your understanding of that drop-down menu has to change. You've been looking at those 15 logos as evidence of a diverse, competitive market. The brands aren't the companies. Carnival Cruise Line, Princess Cruises, Holland America, Cunard, Seabourn, Costa, Ada, P&O, these are all distinct consumer experiences, genuinely different ships, genuinely different cultures, genuinely different price points. They are all also Carnival Corporation and PLC, a single parent company traded on both the New York Stock Exchange and the London Stock Exchange, headquartered in Miami. Cunard has been sailing since 1840 and runs the Queen Mary II, one of the most recognizable ships in the world. Carnival Cruise Line runs ships named things like Mardi Gras and offers a roller coaster on the top deck. Same parent, same financial statements, same annual report. The brands are real. The competition between them at the corporate level is not quite what it looks like from outside. Carnival Corporation built the template, and both of its major rivals ran the same play. Royal Caribbean International acquired Celebrity Cruises in 1997, adding a premium-tier product to its portfolio. 2 decades later, Royal Caribbean Group acquired Silversea, ultra-luxury, small ships, expedition itineraries, completing its own spectrum from mass-market megaship to intimate high-end voyages. Norwegian Cruise Line Holdings assembled its 3 brands similarly: Norwegian at the value end, Oceania in the premium middle, Regent Seven Seas at the luxury top. Each of the 3 parent companies now runs a full spectrum, with each brand positioned to face a different segment of the market and compete against the equivalent tier brands of the other 2. The competition you see on that booking site is real. It's just happening between 3 portfolios, not 15 independent companies. By the middle of the 2010s, these three companies were carrying roughly 3 out of every 4 ocean cruise passengers worldwide. The logistics of what that scale requires, fleet procurement, fuel purchasing, port negotiations, shipbuilding contracts with yards like Meyerwerft in Germany and Fincantieri in Italy, get considerably more favorable when you're placing orders of this size. Scale in shipbuilding is one of the quiet economic engines that makes further consolidation rational. The more ships you're ordering, the better your terms, the lower your per-berth construction cost, the harder it is for a smaller operator to match your economics. Which raises an obvious question. Where exactly are these companies? They're headquartered in Miami. They trade on American stock exchanges. They file with the Securities and Exchange Commission. Their primary customer base skews heavily American. In the conventional sense, these feel like American companies. And then you look at where they're incorporated. For most of its history, Carnival has operated as 2 separate legal entities, one incorporated in Panama, one in England and Wales, a dual structure assembled when it merged with the British P&O Princess Cruises in 2003. Shareholders voted in April 2026 to dissolve that arrangement and consolidate under a single company, legally domiciled in Bermuda. Royal Caribbean Group is incorporated in Liberia. Norwegian Cruise Line Holdings has been in Bermuda since its IPO. Their ships fly flags of the Bahamas, Panama, Malta, the Marshall Islands. This isn't a quirk, this is architecture. Flag state, the country whose flag a ship flies, determines which country's maritime labor laws apply to the crew, governs certain aspects of vessel inspection and certification, and carries tax implications for the operator. Offshore corporate incorporation affects the company's exposure to domestic corporate taxation. For a company operating globally, moving billions of dollars in revenue through routes that touch dozens of countries, the gap between being a U.S.-incorporated company operating U.S.-flagged ships and being a Bermuda-incorporated company operating Bahamian-flagged ships is not decorative, it's material to the economics. And notice where Carnival is moving when it decides to simplify. Not Delaware, not Florida. Bermuda, the same jurisdiction where Norwegian already sits. When the optimization changes, the destination is still offshore. That tells you something about what the architecture is actually solving for. And this isn't unusual in global shipping. Every major maritime operator in the world makes similar calculations. What's notable about the cruise industry is the scale at which it operates this architecture while serving a primarily American market, trading on American exchanges, and maintaining headquarter operations in Miami. For you, as a passenger, almost none of this surfaces day to day. The ship gets inspected, the safety standards are real, vessels comply with SOLAS, the International Maritime Safety Framework, regardless of flag state. The U.S. Coast Guard still operates in U.S. waters regardless of what flag is on the stern. You board the ship, your folio runs, you do Alaska or the Mediterranean, you disembark. The corporate geography stays invisible. What it means for the companies is a different conversation. Which is the moment most people start wondering, so if I don't like how one cruise line operates and I switch to a different brand, am I actually doing anything? It depends entirely on which switch you're making. Moving from Carnival Cruise Line to Princess is moving between 2 brands within the same corporation. The revenue goes to the same parent, the same executives, the same shareholders. You've changed your experience, which is real and meaningful, but you haven't changed your corporate relationship. Moving from any Carnival Corporation brand to Royal Caribbean or Norwegian is a genuinely different company. Different P&L, different executives, different shareholders. The labor geography and corporate incorporation structure looks nearly identical, but the money goes somewhere else. MSC is the genuinely interesting alternative. The Mediterranean Shipping Company's cruise division is privately held, owned by the Aponte family, structured as part of a global shipping conglomerate, and accountable to no quarterly earnings call. It's been growing its fleet at a pace that none of the 3 public companies can match, precisely because it's not optimizing for the next earnings cycle. It's now among the largest cruise operators in the world by number of ships, and the gap between it and the big 3 is narrowing. If the 3 companies frame needs updating in the next decade, MSC is the reason. Virgin Voyages, Disney, Viking, Lindblad, genuine independence, niche markets, collectively a small share, real alternatives if their specific product is what you're after. So here's what that booking site dropdown is actually offering you. 13 of those logos trace back to 3 public holding companies. MSC operates independently, Virgin and a handful of others are the genuine small independents. The menu's long, the kitchen is not quite as crowded as the menu implies. None of which means you've been deceived. The brands are maintained separately because they're genuinely different products, and keeping them distinct is a significant operational undertaking. The crews have different cultures, the ships have different designs, the guest experiences are legitimately differentiated. The consolidation funded the infrastructure, the private islands, the megaship hardware, the port relationships that made modern cruising what it is. These companies didn't homogenize the product, they diversified it from a base of massive shared financial scale. That's actually the harder thing to pull off. Putting Cunard and Carnival under the same roof without the white gloves showing up next to the water slides requires real operational discipline. Go back to that booking site. Same 15 logos. You're reading the shelf differently now. You're not seeing 15 competitors. You're seeing 3 portfolios, 1 private insurgent, and a handful of genuine independents, with each brand carefully tended to feel like a world of its own, because that's how the economics work. The distinctness isn't incidental, it's the product. Those 15 logos are not 15 cruise lines. They are 3 companies' answer to the question of how to sell cruises to every kind of passenger at once, without any of those passengers feeling like they ended up on the wrong ship. That's another one for the cruise files. If you want to learn more about what goes on behind the giant cruise ships, everything from the scams on board to the secrets below deck, subscribe, like, and share. Thanks for watching, and I'll see you in the next one.